Hi everyone, I'm Jane. I'm a master's student in applied financial mathematics. So today I'd like to introduce my project to you. Minimum variance portfolios with different stock selections. This project aims at finding out how different criteria people choose to select stocks may influence their portfolios, risks, and returns. Assuming portfolios are all built using Markowitz mean variance portfolio theory. So people with little knowledge of investments or less time may simply choose stocks based on the gossips of stocks they are interested in. So if people have some knowledge, they may prefer stocks of valuable companies with stable equity prices. In addition, other investors may evaluate financial statements and ratios of companies before they make any decisions. As we mentioned before, we build our portfolios based on Markowitz mean variance portfolio theory, also called Mountain portfolio theory, which is very popular now. And in this project specifically, we choose minimum variance portfolios, so minimize risks by diversification. This formula calculates covariance among returns of stocks in a portfolio, which measures the volatility of the portfolio. Our objective is to minimize volatility of the portfolio, given the condition that each weight should be larger than 0, and the sum always equal to 1. So the black line on the right is efficient frontier, best returns with given volatility. We use convex optimization package in Python to implement this algorithm. Next part is stock selections. So the first, we'd like to talk about the general rules. We use a predefined universe, Quantopian tradable stocks unit US, so which has following specific limits. Market cap must be over $350 million. Medium dollar volume must be over $2.5 million over the trading 200 days. And close price of prior day must be more than $5, and no missing data for the previous 200 days. If a company has more than one shares, the common share with the most dollar value will be chosen. No ADRs and no limited partnerships. We calculate all the criteria as of March 28, 2018, and we exclude stocks delisted before April 20th, 2018. We use Quantopian pipeline to conduct stocks selections. The first portfolio is a portfolio with initial value $1,000. We select 10 stocks based on ideas posted on StockTwits, which is a social media platform designed for people to share messages on stocks. Based on StockTwits trader mood from psych signal on Quantopian, we calculate the 300-day simple moving average of bull minus bear for each stock, which is total count of bullish sentiment messages minus that of bearish sentiment messages scored by psych signal's algorithm to reflect the public's understanding. So finally, we choose 10 stocks with top sentiment scores. This is the code for choose stocks for this portfolio. So next one is a portfolio with initial value $5,000. We also select 10 stocks, but based on different criteria. So that is the market value of companies' outstanding shares, or we also call that market capitalization and equity price trend. We examine the equity price trends by calculating 20-day, 50-day, and 200-day exponentially weighted moving average, or EMWA, of equity prices. So we only consider stocks with uptrend, which means 20-day EWMA is larger than 50-day and larger than 200-day EWMAs. So finally, we choose 10 stocks with top market values. And there's a code again. So the last one is a portfolio with like $20,000. So we select 10 stocks based on fundamental data from Morningstar on Quantopian. First, we choose 5 matrices. So PB ratio, PE ratio, ROA, ROE, ROIC. The formula for calculations are shown here. And then we rank each matrix individually. Last, we'll calculate combined ranks of 5 matrices by assigning -1 to PB and PE, and 3 to ROA, ROE, and ROIC. Because we believe that for the first ratios, the lower is better, so we use -1. But for the other 3 ratios, we believe high is better, then we choose 3. So we choose 10 stocks with top combined ranks. These are the 10 stocks, and these are the codes. We conduct backtest from March 31st, 2013 to March 31st, 2018 on Quantopian for these 3 portfolios. So as we can see, so portfolio of the performance of the portfolio using fundamental analysis. So it's much better than those of portfolios using stock trace or capitalization or equity trends. So which is 88.39%, though the volatility are slightly higher than another 2. Okay, I'd like to show the summary ratios in this table. So the last 3 slides show the backtest of the 3 portfolios. So at the end of my presentation, I'd like to express my thanks to my team members and also Professor Do for the whole semester in 5670. Thanks for all kinds of helps and all kinds of supports for this course. Thank you.